I often like to say there's always a deal to be had out in the stock market, especially for those of you that are long-term investors. The long-term approach is the best way to build wealth. Did you know that if you go back through the history of the S&P 500, decades and decades, you won't find a 20 consecutive year period in which the S&P 500 came out negative? Build wealth over a long period of time. Part of that has to do with patience. The other part has to do with understanding how to value stocks, being able to buy high quality companies at low valuations. This is a big piece of my 6-week investing accelerator course where I get to work with individuals one-on-one, building out a strategy for them, but also diving in to the world of valuation. But in today's video, we're going to be taking a look at 3 high quality companies with 20% upside from current levels. And before we jump into those 3 stocks, do me a huge favor, click that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into today's video, taking a look at 3 stocks with 20% upside from current levels. Beginning with stock number 1, which is Amazon, stock ticker AMZN. Amazon is a stock I absolutely love right now, especially at current levels. This is a well-diversified company that can outperform whether we enter a slower economic period or not. The company, again, is well-diversified. They have an amazing cloud business with AWS. They have a very strong retail business and an underappreciated and very strong advertising business, among many other things as well. The company has a market cap of $1.9 trillion. Over the past 12 months, the stock is up 46%, and year to date, Amazon shares are up 20%. A move like that just over the past few months and over the past 12 months, and I still believe the stock looks intriguing from a valuation perspective, you might ask? Yep, let's take a look right now. As you can see here on this fast graphs chart, that analysts are looking for the company to generate EPS of $4.56 per share this year, and growth is expected to climb roughly 38% per year over the next 3 years. This gives the company a forward PE multiple of 39.6 times, which compares very favorably to their 5-year average of 65 times. The company also has a PEG value of 1.04, indicating superb value even with the high multiple near 40 times. When looking at a different angle, I can see that shares trade at an EV to EBITDA multiple of 20 times compared to their 5-year average of 27 times. This is an angle I really like to look at for stocks. In fact, when looking at this particular multiple, this is one of the lowest valuations you can buy shares of Amazon in the past few years based on this valuation alone. No dividend when it comes to Amazon, but the company has tons of cash and a ton of cash flow in which they continue to buy back stock. Yet another way to return money back to shareholders. Let's take a look at what analysts think. Analysts currently rate the stock a strong buy and have an average 12-month price target of $222, implying 21% upside from current levels. And that brings us to stock number 2, which is Alexandria Real Estate, stock ticker ARE. And if you've watched any of my prior videos, you know that I love REITs and the real estate sector as another way to diversify your portfolio. But if you've been watching the market for any amount of time, then you probably know that the real estate sector has been one of the worst performing sectors, or the worst performing sector in the S&P 500 over the past 12 to 18 months. The reason being, the real estate sector is very interest rate sensitive. And as interest rates have moved high and stayed high, this has really been a ton of pressure on this market. But what is on the horizon? Interest rate cuts, which is going to be that pressure release valve for this sector as a whole, giving us right now the opportunity to invest in high quality REITs at extremely low valuations. Alexandria is more of a scientific research office REIT, very far and very different from a traditional office REIT, but nonetheless, the company is titled as an office REIT, and since the pandemic, many office REITs have really gotten punished. The company currently has a market cap of $20 billion. Over the past 12 months, though, shares are even, but since the start of 2022, shares of ARE are down nearly 50%. So as you can imagine, if the company is able to weather the storm, produce solid operating results, all of which they do In addition to having high occupancy rates, you have the opportunity to buy a high quality REIT at bottom feeder prices. When looking at this fast graphs chart, you can see that analysts are looking for the company to generate a FFO of $7.62 per share this year. That equates to a forward price to AFFO multiple of 15.2 times, and that is very favorable to their 5-year average of 27 times. Now, a 27-time multiple on this REIT can be pretty high, but let's say the company just gets back to a 20 times multiple. That is still upside of a price target of $152. That is still 30% upside from current levels over time. The REIT looks really cheap if you're willing to wait, and while you wait, you get paid a solid dividend. The company pays a dividend yield of 4.4%, which is a dividend that they've been growing for 13 consecutive years. Let's now take a look at what analysts think, where they currently rate the stock a strong buy, and they have an average 12-month price target of $141, implying 21% upside from current levels. And that leads us to stock number 3, which is Johnson & Johnson, stock ticker J&J. J&J and Alexandria, a REIT we just looked at a second ago, are probably two names you didn't expect on today's video. When we click on a video titled 20% upside or 20% growth, you don't think of Johnson & Johnson and Alexandria as growth stocks. But this is why valuation is so important. Both of these companies, high quality companies, are trading at such cheap valuations. So there's a ton of upside just to get back to their average multiples. And in addition, both of those stocks have solid dividend yields. Now, when you see Amazon, which we started off, that makes sense. That there is a growth stock. These, not so much. Johnson & Johnson doesn't need much of an introduction at all, as it's been around longer than pretty much any person watching this video. The company currently has a market cap of $351 billion. Over the past 12 months, shares are down 8%. But they are 21% off their highs back in 2022. The company has gone through a lot of changes over the past year or so as they spun off their popular consumer health segment. Think of many labels such as Tylenol, Motrin, Band-Aid, and the list goes on. Now the company is left with its pharmaceutical segment as well as its medical device segment. Along with that, there's been litigation that's been an overhang on the company as well, bringing share prices even lower. However, Johnson & Johnson is only one of 2 companies with a AAA credit rating, even in the face of these lawsuits. When looking here at this fast graphs chart, you can see that analysts are looking for the company to generate EPS of $10.64 per share this year, giving the company a forward PE multiple of just 13.7 times. This compares very favorably to their 5-year average of 17.2 times. This earnings multiple is one that was last seen at the depths of the pandemic sell-off. When looking at a different angle, I can see that shares trade at an EV to EBITDA multiple of 11.7 times, which also compares favorably to their 5-year average of 14 times. Another angle, price to free cash flows at 15 times compared to a 5-year average of 18.2 times. You can look at a number of different angles, and many of them are coming out showing that shares of Johnson & Johnson are quite cheap. And while you wait for those shares to increase again, you can also collect that solid dividend. Shares of Johnson & Johnson currently yield a dividend of 3.4%, and they have been increasing their dividend for more than 60 consecutive years, which is just incredible to think of. Now let's take a look at what analysts think, where analysts currently rate the stock a moderate buy and have an average 12-month price target of $175 per share, implying 20% upside from current levels. So there we just looked at 3 different companies. One is more of your traditional growth stock, but Alexandria and Johnson & Johnson, not so much. But their valuation is that much more intriguing, and you get to collect a solid dividend. Down in the comments section below, let me know which of these 3 stocks are you more likely to buy in the next month or so. And if you haven't done so, make sure you smash that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.